Welcome back to this tutorial on financial modeling using Kaluta projection methodology. We have thus far established our annual projected financial statements derived from our monthly projected financial statements. Now we are ready to do business valuation from the annual cash flow sheet. But before we do that, we need to develop cash flow statement that has been prepared using indirect cash flow method, because this is the method most of you are aware of. You are actually not familiar with the direct cash flow method or the actual cash flow method that I have used in modeling these financials. Let me explain about this again. I go to the annual cash flow sheet here. First of all, let me put all the annual sheets to the right. So I click on the sheet name, click move, and I move it. It should be after annual balance sheet, and I click on annual P&L, click again and move it. It should go after annual P&L, after annual cash flow here, and then annual profit and loss, annual cash flow, and balance sheet, annual balance sheet. Yeah, it's already there, annual balance sheet. So maybe let me move this monthly balance sheet. Let me move it to go to before P&L sheet. So after loan. Okay. Right. So I have my annual financial sheets at the end, so we can deal with them. Now to the annual cash flow sheet. You see this type of cash flow. It accounts only for cash related transactions. Okay? Those transactions that actually moves cash in and out of the cash balances. Okay? So it doesn't deal with accruals or non-cash transactions. Those movements are not captured in this cash flow, as is the case for other, for example, indirect cash flow statement or even direct cash flow statement. You will start with cash sales and then purchases, and then the rest you'll have to adjust for movement of current asset and liabilities figures in balance sheet to arrive at total cash flow from operation. But here we derive our total cash flow from operation directly from transaction involving movement of actual cash. So this is cash accounting instead of accrual accounting of the cash flow statement. And I call this transparent cash flow because it transparently indicates the actual transactions that moves cash in and out of cash balances. So in this we have total cash flow from operations from actual transactions. We have another component, cash flow from investing activities, cash flow from financing activities, and then net cash flow, and then cash at the end of the period. Okay? So with the indirect cash flow method, we are going to develop an indirect cash flow method that will have to end up with this figure of total cash flow from operations to be exactly the same as total cash flow from operations derived by this actual cash accounting. So that's our target, to show that this approach is exactly the same as indirect cash flow statement approach, because they all end up getting the same total cash flow from operations. Okay, so let me create a sheet at the end of annual balance sheet here. So I click on the plus sign to below, and then to the bottom left corner there is a plus sign. I clicked it to create a sheet. I have it, sheet 1. I click it to rename, so I rename it annual indirect cash flow. Okay, AICF, annual indirect cash flow. Now I let me copy the structure here for months up to here. So I copy this and paste it here in our so we start with, to derive indirect cash flow, we start with profit before tax. So I double tap to write profit before tax figure, which is, start with equal sign and click on annual profit and loss statement here, and that is this figure, profit after tax, here in year 0. Okay, press enter, and then this is true throughout, so I tap to fill to the end of my projection period. Okay, let me select a number of these rows and format this as remove decimal places, then format the negative numbers in red so that we see exactly. So we start with profit after tax, and then we adjust for non-cash transactions. Okay, these are depreciations, gain and losses. Okay, so for our case, let's see what non-cash transactions we have that were reported in our profit and loss statement. So I go to annual, I click on sheet annual P&L to see first the transaction. We have depreciation is actually, it does not involve cash movement. For bad debts, in this case, you don't find, but in annual cash flow, if you come here, you don't find bad debt here in cash flow from operations. Okay, why? Because of the way, let's see how we model our bad debts in the workings here. So the way we have modeled bad debts, we say out of the credit sales we have, 2% is going to be bad debt. So we expect on each month we will have 2% of the credit sales to be bad. Okay, which means we expect to collect 98% of credit sales during that given month. So we have modeled it that way. So the bad debt has been booked in profit and loss statement. So if we come to our income statement, annual income statements where we were here, we see bad debt has been expensed in profit and loss statement. Okay, and equivalently, the credit side of it has been booked in debtors figure itself, because debtors has been accounted after deducting the bad debt. That means we have used a direct method of accounting for bad debt. We did not create an allowance account for bad debt to accrue it. And the logic for modeling is, when you model expected debts, you expect them to occur in that timing you are modeling. Okay, so you don't model reserve and then you wait for actual. That is where you do actual accounting. But for projecting, you model expectations of debt, so you expect them to occur when you model them. So that is the reason why I didn't use an allowance method for accounting for bad debt, but I use a direct method where the bad debts are expected to crystallize in duration or in time on which we have modeled them, right? So the debit is in profit and loss, and the credit is in debtors, because it reduces the debtors balance by the amount of bad debts that have been paid. So the bad debt, since because it is reduced in debtors, and the debtors is in the current asset section of the balance sheet, so the movement for cash relating to bad debt will be reflected in the movement for debtors. This is what we are going to do in our modeling of indirect cash flow. That's why we do not adjust for debtors. So we will adjust for depreciation for non-cash flow items. So I come to my sheet here, annual indirect cash flow method, and I type depreciation. Okay, and here I start with equal sign, go to annual P&L, pick the depreciation figure for January, which is here. For year 1, year 0, which is there. Press enter, and this formula is going to be true, so I tap to fill it throughout the projection period. Okay, so depreciation is a non-cash movement that reduces profit but actually does not reduce cash, so we add it back. So we have added back depreciation by putting it to be a positive figure. Negative numbers are presented in red, whereas positive numbers are shown as the year. Okay, so we have already adjusted for depreciation, and now we go to do adjustments for movement of current section of balance sheet. Okay, so we start with current assets. Let's go to the annual balance sheet here. I click on the sheet on annual balance sheet, and then in the current assets we have cash, debtors, advance payments, and closing stock. Cash is the balance at the end, the closing balance of the cash account. Okay, so we don't model it, we don't account it in indirect cash flow method because it is a residual amount. So what we will account is other current asset item, that is from debtors to closing stock. So I select these up to here, current assets, I copy them, I go to our annual indirect cash flow, tab 2 to paste them here. So I've pasted them there. And assets, when current assets increases from current period compared to previous period, the increase draws out cash. Okay, so when current assets increase, they reduce cash. So let us model the movement of cash at year 0. Here at year 0 is the starting point. So the previous point is 0 because we have just started. So to model the movement of current assets, I start with equal sign, I start with 0 and then minus, I go to annual balance sheet, to the data section. In year 0, click on debtors, press enter. So that is the formula. If let me tap to drag it down, to fill it down here in year 0. This is applicable on year 0 only. So for advance payments, we have item there. We have the figure there. So you see the advance payment is presented as drawing out cash from this cash flow statement because it is red, and that's why I modeled it to be a minus figure when asset increases. Okay, you get the logic. So let's do for year 1. So the formula for capturing the movement of current assets will be starting with equal sign, go to annual balance sheet, and then click on, for year 1, you click on previous period, which is here, minus current period you are dealing with, which is here at year 1, and then press enter. Okay, so that formula is true throughout. So I tap to fill this going down, and then fill this going to the right of the projection period. So when asset increases its balance, that one draws out cash from this cash flow statement, indirect method. So we are done with the current assets. Let's go and see what current liabilities items we have in our annual balance sheet. So I click on annual balance sheet. Here in the current liabilities section here, we have short-term loans, creditors, bank overdraft, accruals. Short-term loan, this is the component of cash flow from financing activities. So it's not covered in cash flow from operations. We leave it. Creditors, that's okay. Bank overdraft. For bank overdraft, as we have modeled this in this presentation, this is a part of balance cash flow, balance of the cash. So when you talk about cash and cash equivalents, bank overdraft is part of it. So it's not taken into the movement of current assets. This is how we have modeled bank overdraft here. We could have modeled it to be as part of creditors, okay? Assuming that the overdraft facility is given for you to operate your business on short-term basis, so we could gross it up with creditors there, but we haven't used that approach because this approach is more logic to account bank overdraft separately from creditors, because first of all, this is not typically payable transaction. This is financing transaction. But when you get a bank overdraft, what they do actually is just they allow your bank balance to be overdrawn to a certain limit you are given for the bank overdraft. Okay, so it actually directly relates to your cash balance. Okay, so that's why I've modeled it as bank overdraft as separate. And for that matter, the bank overdraft portion is not going to be reported in movement of current liabilities, because it is part of cash and cash equivalent items, which we are deriving when we do our adjustments in our indirect cash flow method. Okay, to derive the cash flow from operations, from financing, from investing, from financing, and then cash flow at the end of the period. There is where the bank overdraft component will rest as cash flow at the end of the period. So that means I'm taking creditors and accruals, okay, to go to our adjustments for working capital items in this direct. So we have creditors and accruals. Okay, to start with, equal sign, and then goes to annual balance sheet. So creditors here, we start with for year zero it will be click on year 0 and then minus 0, because previous is 0. So we press enter. And this one is also true for accrual. So I click equal sign, go to accrual, balance sheet here, annual balance sheet, to accrual the same. Click on here, minus 0, press enter. Okay, that is for the first year. That is the formula for the first year. And because we have figure for accrual, you can see if we go to balance sheet, in year 0 accrual we have 430,000, and since it was 0 in before year 0 and now it is 430, that means a liability component has increased, and we have said when liabilities increase, they increase cash. So that is the logic of the formula for year 0. And for year 1, this one is going to be equal to, click on annual balance sheet here, and then we click on current figure minus previous figure. Okay, so here minus this figure. Okay, and this one is going to be true, so I fill. No, I cannot fill this for accrual. I need to do the same. Why? Because creditors and accrual are in different parts in balance sheet. Okay, because after creditors there is bank overdraft and accrual. So if I will drag it, I will have the wrong formula here. So I need to start with equal sign, go to balance sheet, click on accruals, which is here for year 1. So we take this figure minus previous one. Okay, press enter. Now these two formula I can select them I can select them and fill them to the rest of projection period. Okay, so you see, when liability increases, it increases cash, and that's why the cash is reported as positive figure. So we are done with our adjustments for non-cash transactions and for movement of the current assets balances in the balance sheet. So this one should give us now our cash flow from operations, which is the sum of all these. So I just sum this, enter, and this formula is true. So I tap this to fill. Okay, so we are done with our cash flow from operations using indirect cash flow method. Now let us compare the cash flow from operation using this indirect cash flow method with the actual cash flow method, or the transparent cash flow method that I have used in modeling our financials. So I put a check here, and in this check I'm going to put a formula. I take this figure, cash flow from operations derived from indirect method, minus for year 0. So minus, I click to my cash flow, annual cash flow here, using transparent or actual method, and total cash flow from operations for year 0 is here. Okay, and then I press enter. So if the answer is 0, then that means these two cash flow from operation from indirect and from the actual method are completely the same, which is what we should expect. So let me tap to fill this formula throughout our projection, because it is true. And if we have zeros, so we have zeros, so that means our check is okay. So I think you get the point why I had to develop this indirect cash flow method, because first I wanted to show you that the methodology I'm using in projecting cash flow is exactly the same with the indirect cash flow method, which most of you are used to, because the method, the actual cash flow, you don't find it in academic. Oftentimes, for those who have been in banking industry, when you want a bank overdraft, the actual cash flow method or transparent cash flow method is the only presentation the bank would want you to prepare for modeling your overdraft. They would not accept presentation using indirect cash flow method, okay, for bank overdraft, because the bank overdraft duration is 1 year, and it needs to indicate the movement of expected cash flow from operation, which should swing. Okay, so the bankers and those business people know what I'm talking about, because if you have requested for bank overdraft from the bank, then this is the actual cash flow method I've used in modeling is the one that they would need you to present. Okay, so that's why the reason why I had developed this indirect method. But the other, because we are now going to model business valuation, and because you guys are familiar with the indirect cash flow method to derive free cash flows, that is unlevered free cash flow, for the purpose of business valuation. That's why I have to develop this indirect cash flow method, so that you see the methodology I'm using is exactly the same of what you are used to, but only in different approach. And definitely my approach is the best, as I said, in the banking perspective, but also in reality, because when you deal with cash transactions, and those transactions are reported are reported on cash basis transparently, then that cash flow becomes more meaningful than re-engineering the numbers from different financial statements. That means from profit and loss and from balance sheet, and to derive cash flow from operations. That's why many people find accounting to be a very difficult subject because of those re-engineering elements you need to do in order to derive financial statements. Of course, there is a reason why it is done that way, because if you are dealing with financials that have already been presented to you, that is that is the only viable way for you to develop the cash flow. But if you have the information from the company, and you can develop this cash flow way of modeling I'm using, then that is much better. So let us end up here in this tutorial. Next, we are going to develop business evaluation for this projected business presentation. Thanks for listening. Subscribe subscribe to my channel so that you get notified of other tutorials that I'm going to share relating to this financial modeling using this Kaluta projection methodology. Bye for now.